Aashish Agarwal, Head of India Research at CLSA, joins us right now on the show. Ashish, good having you. Thanks for joining in. How do you see the RBI monetary policy stance going ahead, given high inflation still remains a concern?
So, the House, we expect RBI to continue to tighten a bit from here. So, we expect 2 rounds of 25 basis points hike to the repo rate. At the same time, the effective rates may not go up much because we do expect the caps on MSF, etc. to be removed. So effectively, while currently it's the MSF rate, which is the effective rate, once we transition to the repo rate as the more effective rate, on a blended basis, the rates would still end up being constant. At the same time, as far as banks go, we do expect banks to keep raising rates because if you really look at since the RBI tightened, hardly any banks have raised their lending rates. Some private banks have raised rates by anywhere between 25 to 40 basis points. But barring 1 or 2 public sector banks, most public sector banks have really not raised rates. So I think on a blended basis, we do expect banks to raise lending rates by anywhere between 25 to 50 basis points.
Ashish, afternoon. So tell us what you think that would exactly mean for the margins of banks. Do you expect that the deposit rates will also be hiked along with the lending rates?
So far the banks have largely kept deposit rates also fairly intact. I think margins have been surprising on the upside. Second quarter, most banks kind of maintain margins, very contrary to expectation that margins for the banks will collapse. I think what we are saying here is that margins should remain stable, especially for the banks that have higher deposit franchise or superior CASA ratios. Whereas for the wholesale funded banks, which are predominantly the tier 2 public sector banks, margin could continue to trend down in the coming quarters.
What about asset quality? I mean, how worried are you? The RBI may announce something on that front this week. So what would you expect?
I think asset quality pressures are pretty much there. I know second quarter results have been looked upon as much better than what the first quarter trends were. But that's not really, I think, a comforting factor. Second quarter, new NPL formation, absolute level of NPLs for most banks continue to be very worrying. They have moderated a bit from a very elevated first quarter levels, but still are higher than anything that we have seen in the last 3 to 4 quarters, which means that asset quality pressures are still pretty high. Especially one new trend that we saw in the second quarter results was it's the smaller banks now which are seeing more asset quality pressures rather than the big banks. So SBI seems to be showing some signs of stability of asset quality. However, the tier 2 public sector banks, as we call them, are continuing to see much higher slippages in NPL formations. On what RBI might do, I think there are talks about RBI might empower banks to go against or go after the willful defaulters, which is positive for the system. I think it gives the right firepower for the consortium kind of lending for the banks. But it will take its own sweet time to kind of get impacted in the financials. Even if bank starts acting now, it will be at least 3 or 4 quarters before you could see some kinds of upgrade, recoveries, etc. Meanwhile, the profitability pressures will continue to stay very high, and especially for, as I said, public sector banks in the tier 2 space.
How do you see the Treasury income impacting the P&L for some of these banks then?
I think Treasury gains will probably remain negligible in the coming quarters. In the past, we have seen banks reporting decent level of Treasury gains. In the second quarter, when the yields went up, banks were given a window to shift their holdings from AFS to HTM. Most banks have utilized that window and shifted a large part of their holding to the HTM category, which means they don't need to mark-to-market that part of the book anymore. And that's the reason, as far as Treasury gains or investment provisions are concerned, we will probably see negligible in terms of neither a big gain nor a big loss coming through. On a real economic basis, however, there would be an impact. So even if a bank has transferred securities to the HTM part, there is still an economic hit, which will be more captured through the margins coming off in the coming quarters rather than coming through the Treasury lines.
Your top picks in the private bank space, and why do you like them?
So we prefer, of course, the private banks. Within the private banks, we have a preference for the corporate lenders. Our thesis for the sector is that while the market is worried about some of the large corporate asset quality issues. We don't think we will see a large corporate NPL cycle. In fact, we have been advocating that the large corporates will go through a deleveraging process. It will be a long-drawn process, but nonetheless, it will take place in the next 12 to 18 months. We have seen some signs of it. There have been corporate assets aggregating to more than $5 billion that have been sold in the last 12 to 18 months. We believe another $7 to $8 billion will get sold over the next 12 to 18 months as well. And as that process goes through and the risk of corporate defaults start moderating, you will basically see large corporate exposure banks like ICICI and Axis Bank re-rating, because at the current valuations, which is close to 1.5 times book, these banks are practically pricing in some element of chunky defaults from the corporate book.
So Aashish, let's get a little bit stock specific now. What do you think within the NBFC space has good potential?
So we prefer very selective NBFCs. We like HDFC and we like IDFC. We like these two because of the strong business model that they have. We believe the triggers for these stocks would be the easing of the wholesale rates or, normalization of liquidity over the next 3 to 6 months. And to that extent, as banks also start raising lending rates, there will be some normalcy as far as competition is concerned. So we continue to like both the names. Of course, some of the NBFCs are also contenders for new bank licenses, IDFC being one of them. We think it would be a good opportunity for them to convert into a bank. But outside that, we really don't like any names. Power Finance, REC are stocks that we have underperformed ratings on.
You mentioned IDFC's banking a license contender. Which other companies do you expect to get these licenses?
I think the licenses, what the talks are supposed to be, given to players in the infrastructure financing names. So L&T Finance, IDFC are, of course, the key contenders. Whether the corporate entities do get a license or not, that will basically determine whether you see Aditya Birla Nuvo or a Tata Capital getting a banking license or not. Outside that, I think it's too speculative at this point of time to comment on who can get it.
Now, Aashish, the RBI has eased the foreign bank conversion norms, and also we're going to see new banks. Do you see higher M&A activity now within this sector? And if so, which are the banks which you think we could see a higher possibility of M&A kicking in?
Sure. So I think the foreign bank rules are still very advanced stages. There are a lot of clarifications yet to be issued out. We need clarity on what would be the reciprocal arrangement with the origin of the foreign bank. I think that's a big step to be clarified. There are also clarity required for tax laws. So till we see the clarity on that, I don't think there will be a hurry of foreign banks trying to subsidize their local entities. Once that happens, it would be interesting what strategy do they adopt. Will it be organic? Will it be inorganic? I think a few small private sector banks are, of course, contenders. The old generation private sector banks, whether it is Federal, Karnataka, South Indian Bank, these banks have been, always talked about as a potential M&A candidate, and especially when the foreign banks step up. But